High growth stocks are down between 40 and 80% this month alone, with Goldman Sachs reporting its worst month for high beta and high growth stocks on record. What does this mean for you? I'm going to show you in this video exactly what I would do if I started investing in 2026 right now, step by step, and how you can miss out on all the beginner mistakes and get straight to investing properly. If you're new here, hi, I'm Ben. I've grown and exited over 5 e-com businesses of my own that I've created. I've helped and personally coached individual investors through options and derivatives in order to actually grow their individual stock portfolio. And I've been personally invested in the market for over 5 years. So I've seen the ups and downs throughout COVID, throughout all these different AI and tariff crashes. So I'm able to give you the actual advice to help you stay in the market and keep your portfolio growing through the years. So in this video, I'm going to show you guys how you can open your account, how you can take advantage of free shares, which is crazy because it's a free advantage on getting free stocks or free cash on your deposit. I'll show you the exact strategy to copy that is proven and works, and also how you should actually structure your actual investment account so that money's going straight in without you even thinking about it, because we know overthinking will actually lead to most of you guys not investing money into the market. I covered that in my last video, but that is one of the most important things, is just staying in the market. So your first step is actually going to be your account setup, which doesn't have to be complicated. I feel like people actually tend to just overcomplicate this because they think, oh, it's going to be with me for the rest of my life. And that's the good thing. If you choose a good broker, you don't need to actually have to worry, because typically they have FSCS insurance, which covers you up to £85,000 if you actually get, if the broker goes down. In the US, I think it's SIPC. That does not cover if your investments go down. It covers if the brokerage fails. So that's just a little bit of insurance that you guys have. So that's the first thing you need to cover. And typically your biggest brokers will already have that included within their overall setup, just because they're regulated. So typically you'll see IBKR, Interactive Brokers, Trading 212, Charles Schwab. They're the 3 biggest ones that you probably could actually sign up with. I personally use IBKR because I like their user interface. I can actually get in touch with a real human if I actually need to, which was a big tick for me. So that might be for you guys as well. But the 3 things that you actually guys need to make sure they cover is, number 1, they have low fees, because that is where secretly your money will potentially get eaten up over time, because a little chunk every single year can take a bit out of that compounding effect over 30-40 years. So that's a big thing. You want to have low fees, and typically the bigger brokers tend to have the lower fees because they're more competitive. The second one is that it includes the indexes that I'm going to cover in this video, so you guys can actually protect your money and grow them in a stable and safer way. And the third one is actually to make sure that you can withdraw your money whenever you please, whenever you need to, because I've heard so many stories about people using certain brokerages just because they can get leverage, which we're not going to talk about in this video, and they're unable to actually withdraw their money whenever they need to, because sometimes some brokers will say there's a 180-day lockup period, but these top brokerages should all be fine. Like I said, because they're well known, they're regulated, so there's nothing to worry about. But they're just the 3 ticks that you need to make sure. And personally, IBKR, Trading 212, and Charles Schwab pass all of those. The second step is free money. And over 90% of beginner investors actually leave this out. And that's a real statistic by brokerages. And I don't understand why, because if you're getting a free share or a deposit bonus, which is typically what brokerages do, that is actually free money compounding and growing alongside your investments. So make sure you guys don't leave that on the table. Typically, a referral bonus will give you up to £100 or $100 or in the hundreds. Well, I've got a referral bonus for you guys I'll leave in the description, which is up to £1,000 if you actually sign up with Interactive Brokers, which is crazy because that is just probably as big as most people's starter deposits will be. So it's phenomenal. Make sure you guys don't leave that out. Another second one is your employer match, your employer contributions. If you are leaving this out, and I've spoken about this in every single video I've made in the past, because it is key. Most people don't check it, most people don't even care about it, but if you're contributing and your employer is matching that contribution every single month, that is 100% free return on your money that you can never get anywhere else. No AI stock, no memory stock, no investment is ever going to be able to match free money. So that's why it's important and imperative that you guys check with your employers if they do a contribution match. If they do, try to max it out every single month, because there's nothing that's going to actually beat that contribution other than you working harder to put more money into your investment account. So please don't leave that free money on the table, because it adds up over time. Even if it's £50 or £100 a month, it will definitely add up over time. So step 3 is actually copying this proven strategy, and it's going to be boring. It's not supposed to be glamorous or supposed to be fun or interesting, but it works. It It's proven, and it's what's going to keep your money growing for you without having to panic or worry. And that's by buying broad index funds, global index funds, which comprise of the top 500 companies or top 500 US giants. And that's the best way to diversify your actual fund and your cash to keep it growing for you, because they're the best companies that are continuously growing, adapting, expanding. And it doesn't mean that you have to guess what the next best sector is going to be. Is it going to be AI? Is it going to be space stocks? Is it going to be energy? You don't need to, because you're buying whatever wins. You're buying a chunk of everything, and whatever wins, you're going to win as well. So that's the big thing for you guys. So that's rule 1. Rule 2 is invest the same amount every single month, no matter what the market does. And this is imperative because it teaches you from a younger age, or whenever you're starting, that even fear in the market is not going to stop you from putting money in. You have to remember, you're trying to stretch that money that you're investing every single month as much as you can. So if you're putting £500 into the market one month when the market's higher, if the market comes down 10% because a big crash happens, that £500 is going to get you more shares of whatever you're buying. So when that market returns to that stable price, whenever it does, you will actually have more money because you're buying at lower prices. That's called dollar cost averaging or pound cost averaging if you're in the UK. Same principle, just different term. And that's the most important thing, because it teaches you from a starting point that, you know what, I'm going to keep buying consistently. I don't care what the market is doing. And that's the habit you want to get into. And rule 3 is automate it. Automate these buys every single month, because like I said in my last video, you're not going to do it yourself. The habits tend to change. When you get a pay rise, if something happens, you're going to think, hey, I want to buy that new phone, I want to buy that new game. And that's going to dig into your investment pie ever so slightly, but it will just add up over time, because £50 here, £50 there is not going to do the best for you. So automate it. £200 a month, £100 a month, £500 a month, whatever is the right amount for you, whether it's a third of your salary, 50% of your salary, automate it. So it just takes it out of your mind. It's not you requiring to do it. It's just automatically going in there and being invested. It's working for you. So that's rule 3. Step 4 is what I would actually buy. And this is the key thing. So make sure you guys note this down or pause the video and keep writing it down, because you want to actually be in global stocks. Okay, so you could look at the FTSE, which is the FTSE, or you can look at the S&P 500, or in the UK, because you can't actually buy into the S&P 500, you can buy the VUAG, which is the exact same. It covers the top 500 US companies, and it's already diversified. It means that you don't have to focus on worrying about what needs to grow themselves, what sectors I need to focus on. It does it all for you. So that's one of the best things about that actual index fund, is that it just allows you to do it itself. You could also look at the MSCI, which is a world tracker. So that basically covers the stocks that the S&P 500 or VUAG excludes. So these companies exclude anything that's not US companies, but the MSCI world tracker covers the top companies throughout the globe. So it doesn't have to focus on a single country doing well or a single area doing well within the market. So that's another really good thing. If I was setting it up for myself, I'd probably go 50% into MSCI World Tracker, 40% into VUAG or the S&P 500 for the US folk. And if I wanted to delve into any singular stock, let's say if I wanted to put money into Google independently, or money into Tesla, or money into Amazon, I'd stick with 5%. Just because if something goes wrong, you kind of know that I put 5% in there as a bit of a riskier gamble, a bit of a riskier take, because I believed in that company itself. So I would stick to any individual stocks themselves with a 5% weighting. But majority of it, you just want to put it into an index or a global index and forget about it, because that's the best way that you're not going to be panicking about a 20% move in an individual stock. You'll just be like, okay, my money's going straight into there, and over time it's going to grow and compound and work for myself. And that's the best way. It's hassle-free, and that's how you want investing to be, especially as a beginner. Step 5 is selling. And this is the biggest mistake within the market. This is what I said to you earlier on, where a lot of beginners get caught out because they don't understand the volatility, and they also can't comprehend seeing their investment account down ever so slightly, or down 20-30%, which is a big drawdown, but it's typical within the market, especially with how fast the markets are growing currently. And you can see here what we had this month. The stocks like memory stocks were up over 100%, triple digits this year alone. So a 50% decline that we've had and seen, people would have sold, and people have sold and locked in real losses on their investments. But you have to look at a broader long-term approach. Those stocks are still up 50%, but it's beginners that think, wow, it fell 50%, it's going to fall another 50%. And that's why I say, if you are going to put money into individual stocks, keep it at 5% that you're happy to hold for the long term. And that 50% drawdown is not going to affect you. Because if you lock in those losses, they're permanent. It's not a temporary loss anymore. It can't go back up to regain that difference. You've locked in a loss. And that's going to eat you up mentally because you might think, oh, how can I get that back faster? And it's a loop you don't really want to fall into, but it's a loop that beginners tend to always seem to find themselves within. That's why I stress that you must, at least at the beginning, just get your foot in the door with index funds and global index funds, because over time you will still start to see your money grow and work for you independently, and that alone is good. That alone is more than you could ask for. The main issue that you'll actually start to see is that as soon as any sort of dip happens, a correction, 5%, 10% in the market, you'll see retail panic. You'll see media outlets, news outlets just start showing this is it, this is the end, this is going to happen now, stocks are going to come have their worst decade ever in history. And that doesn't help, but they do it deliberately because if you understand the psychology of markets, that's kind of what forces capitulation. So typically hedge funds will actually start buying whenever media outlets start screaming at the top of their lungs that the market's over, because that's typically a low, because that kind of panic and fear is what puts retail traders like you and me down. So we would sell here at the bottom when fear is peak, and these smart investors called smart money will actually come in and start buying. So you don't want to do that. That's why I'm saying you just want to hold and buy every single month regardless of where the market is. And if you're thinking, when would I sell? So I would only sell if I'm rebalancing my portfolio. For example, if my 5% stock pick that I had went to 10%, I might sell to go back to the original 5% and reallocate that money elsewhere. It's called rebalancing. Or if I'm in a stock and a certain thesis changes or a fundamental within that company changes that makes me think, okay, I'm not really happy with that revenue growth, so I'm going to sell out of that company and just put money back into an index fund. They're the only reasons why I would sell. There's this saying, I'm sure you guys have heard it, it's not about timing the market, it's about time in the market. And that couldn't be more true. I stress to anyone, people that I've coached, anyone that I know, friends, family that get into investing because of me, you just want to actually just get in as early as you can. Whether it's a portion of your salary, a savings, you want to get in because it starts that habit in your mind unconditionally that, you know what, something's working for me in the background. And that is the biggest accomplishment that you could ever achieve, because waking up and seeing a 5% growth in your account by doing absolutely nothing, it just shows that money can work for you without you having to put time and effort into it. So this is something growing passively and you're just contributing rather than focusing on spending elsewhere. So this is it. That's how I would invest if I was starting again in 2026. If you did enjoy the video, I'm sure you would like to see exactly how most people in their 20s and 30s fall for the income trap. And it is much bigger and more likely than you think, and maybe you yourself have fell for this trap. If so, check this video out because I'm sure you'll like it and it'll help you out a ton. Thank you for watching, and I'll see you in the next one.